Hi, my name is Ben Studstill. I've been working with William Stevens and Yang Zhau, and today we will discuss the facts and analysis of the fraud that occurred within Worldcom. If you take a look at this organizational chart, you'll notice a very hierarchical structure with sole power of decision-making lying with Bernard Edwards, the chief executive officer, and then under him, Scott Sullivan and Ronald Beaumont. This is a very hierarchical structure, as I stated earlier. Communications are very linear, and power ultimately resides with the CFO, the COO, and the CEO, which came into play in the fraudulent actions that occurred within WorldCom. Here is a timeline between 1983 and 2005 depicting the events that happened from the beginning of WorldCom's existence to the sentencing of their CFO and CEO. We'll start by looking at the major players within the fraudulent actions that were committed, starting with Bernard Edwards, the CEO of WorldCom during this time. He was described as risk-seeking and free spending. He was quoted as also saying in 1997 that he wanted to be the #1 stock on Wall Street. He operated various other businesses, including rice farms, timber farms, and various other organizations. Another major player in the fraud that was committed by WorldCom was Scott Sullivan, the CFO during the time that the crimes were committed. He was one of the most highly regarded and most well-paid CFOs during his time at WorldCom, making $19 million in 1998. He also made a lot of money off of stocks and bonuses that were probably attributable to his fraudulent acts during his reign as CFO of WorldCom. Cynthia Cooper served as the Director of Internal Audit for WorldCom, and she was ultimately responsible for the discovery of the fraud. She led a 24-man internal audit team, and their focus was primarily on the operational side of WorldCom's business. The financial audit was the primary responsibility of Arthur Anderson during this time. WorldCom's corporate culture was very top-down in nature and ultimately dominated by the CEO, Bernard Edwards. They were only concerned with meeting stockholders' expectations, as stated by Bernard Edwards. He wanted to be the #1 stock on Wall Street. This led to many of the fraudulent actions and transactions that were reported by WorldCom during this time. Now we need to look at the motivations behind the fraudulent actions that were committed by WorldCom executives. They wanted to meet the expectations of stockholders. During the early years of WorldCom's emergence, their stock was rated very highly, but began to decline later as demand fell and more competition arose. Ebers wanted to be the #1 stock on Wall Street, and he was focused on making that happen. As a result of their stock increasing, Ebers and other executives, such as Sullivan, led an ostentatious and luxurious lifestyle. The better the stock did, the more money they eventually made. They wanted personal and emotional satisfaction. Providing for their employees and making sure that everyone was living a good lifestyle was very key in the fraudulent actions that were committed by Ebers, Sullivan, and various other employees. We must look at conflicts of interest to see how Ebers and Sullivan made their decisions. We look at executive personal benefits versus the company's personal benefits first. If the stock price were to increase, executives such as Ebers and Sullivan were rewarded greatly through bonuses and stock incentives. However, if these two had operated under the laws of GAAP and PCAOB, the company might have benefited as a whole and not resulted in the bankruptcy and subsequent conviction of these two executives. Sullivan's relations with Ebers. Sullivan always felt loyal to Ebers, and he basically followed all the orders that Ebers had given him, regardless of whether they were legal or not. Had Sullivan acted in accordance with the law, the company might still be viable today, and bankruptcy and the conviction of these two might not have occurred in the first place. Earnings management is a practice used to present an overly positive view of the company. It is widely used as accountants are given multiple sets of procedures when reporting certain transactions. Earnings management becomes fraudulent reporting when these transactions are falsified or intentionally misstated to provide the company a better financial position. The fraud triangle allows us to analyze and see how and why fraud was committed in the first place. Perceived pressure. Ebers and Sullivan wanted to be the highest rated stock even in an economic downturn. While other companies were not doing well, they wanted to show massive amounts of profit to increase the value of their stock. Perceived opportunity. The opportunity mainly confided in the hierarchical structure of Worldcom. As stated earlier, it's a very top-down approach. Lower level employees were not allowed to question their superiors in threat of losing their job. The corporate culture was basically the same. Sullivan and Ebers demanded respect. They wanted no questions asked, and they were basically allowed to get away with whatever they wanted. Every fraud committer has some sort of excuse as to why they wanted to rationalize the fraud that was being committed. Some were to look out for the better of their employees. Others want money, and various other excuses. For Worldcom, they basically ran out of options to make the company more profitable. They ran out of legal options, to be specific. So they turned to these fraudulent reporting techniques, including the capitalization of expenses that should have been actually expensed on the income statement, and the release of accruals to increase liabilities and decrease these expenses, both increasing net income. Next, we will look at the stakeholders that were affected by the fraudulent actions committed by the Worldcom executives. First, the employees. There were a total of 30,000 jobs lost after the downturn of Worldcom. This was a result of the fraudulent actions and the loss of money that arose from the decisions made by executives. Shareholders. At once, the stock price was rated very highly on the NASDAQ, but as soon as these fraudulent actions were uncovered, there was a huge loss on any stock investment made into WorldCom. I think their credit rating was eventually rated as a junk bond, non-investment grade stock. Companies holding debt. There was a total of $35 billion that WorldCom owed to creditors or suppliers or really anyone that they owed money to. After the downturn of WorldCom, they were paid cents on the dollar for what they were actually owed. Prepaid capacity was a very interesting part of the WorldCom attempted cover-up of their fraud. It was designed to represent the costs of leasing fiber optic lines that had fallen out of use. Instead of booking the costs of these fiber optic lines as expenses, Sullivan instructed them to capitalize these expenses and book them as assets. This was not in accordance with GAAP, but nobody questioned Sullivan due to their hierarchical structure. And if you were to question your superior, there's a good chance that you would lose your job. Cooking the books describes fraudulent activities performed by corporations in order to falsify their financial statements. Pressures to cook the books include meeting financial expectations and achieving a better position over the competition. Other executives wish to cook the books to remain loyal to the executives over them. WorldCom, in order to cook the books, reduced reserve money and moved it to a revenue line, classified operating expenses as long-term capital investments in order to decrease expenses and increase net income, and released accruals that Sullivan deemed were too high to the estimated future cash payments. Next, we will look at the effect on the financial statements before the fraud was ever detected, starting with the accrual releases. Scott Sullivan, in order to increase net income, demanded from certain employees to release the accrual of expenses into a liability account, stating that these accrued expenses were overvalued in comparison to the expected future cash payment. This artificially increased the net income, and in one instance, he requested a release of $370 million in accruals, And when he was denied this request, he had Betty Vinson acquire the account number for this accrual and change the record herself. Next, the capitalized line costs. Another way that Sullivan deemed would be appropriate to increase net income was to decrease these lease expense costs and by capitalizing them into assets. He ultimately overstated capitalized assets by $3.5 billion in 2001 and ultimately inflated profits by $3.8 billion. The internal audit team was led by Cynthia Cooper, who commanded a 24-member internal audit team. She reported directly to Sullivan for most purposes. Gene Morse and Glenn Smith were both internal audit managers and helped Cynthia Cooper uncover this fraud. They first received a tip from the head of the wireless business unit who complained about a $400 million accrual for expected future cash payments that had been transferred away. Cooper asked Arthur Anderson and the audit committee for explanation of this transfer, but they either had none or they denied her this explanation. In response, Cooper decided to expand the internal audit scope without informing Sullivan, so he would have no knowledge that she was expanding the scope and was on to him for his fraud. Cooper asked Morse to access the computerized journal entries that Worldcom had, and he was granted this access through a senior manager in the IT department. Morse worked at night to go unnoticed, and by day examined the downloaded materials and copied these materials so that they could not be destroyed later by anyone in the Worldcom that was involved in the Worldcom fraud. Ultimately, Cooper's team discovered $3 billion in questionable expenses, including $500 million in undocumented computer expenses. Cooper and Glenn Smith looked for these explanations for the questionable expenses and undocumented computer expenses, but no support was found for these entries. The actions taken by managers were not detected earlier due to the hierarchical structure of the company. You were advised not to question your superiors for safety of your job. There was virtually no risk assessment process. And the internal audit function was limited only to operational audits, with the financial audit being the responsibility of Arthur Anderson. They only audited Worldcom as a medium risk client when in reality they were a maximum risk client. They were negligent in the audit of Worldcom, and if they had paid more attention, there's a good chance that the fraud would have been uncovered a lot earlier. The control environment. The control environment is supposed to be set up by top management. They're supposed to just display a good attitude of corporate ethical values. The commitment to integrity and ethical values was virtually non-existent. The board was also presented falsified information, and Arthur Anderson was actually granted very limited access to corporate documents. Had they had access to these documents, there's a good chance that the fraud could have been uncovered much earlier. Now we get into the ethics and behavior of the individuals surrounding the fraudulent actions committed by Worldcom. Through the use of intimidation, Scott Sullivan, the CFO, ordered his employees to commit these fraudulent actions. He told Cooper to keep away from the wireless business unit whenever Cooper inquired about certain suspicious transactions. Cooper recalled never being talked to in the manner that Sullivan talked to her by any other person. Some ethical issues that surrounded the situation. Should we bankrupt the company or do what is right? Cynthia Cooper faced this ethical issue whenever the fraud occurred. Cynthia had close ties to the company. A lot of her family and friends had a significant amount of shares within the company, and if Worldcom were to go bankrupt, they might lose a significant amount of money. Cynthia had various ethical obligations. An internal auditor needs to remain objective, unbiased, and independent in the assurance over financial reporting. She had to look at the benefit of the company versus the benefit of its individuals. Should the company do what is right and report legal transactions, or should we commit fraud, report false transactions in order for the stock price to artificially increase? Cynthia Cooper was obligated to various parties. First, she was obligated to the company as a whole and the laws set forth by GAAP, the PCAOB, and the Institute of Internal Auditors while she was serving as the Director of Internal Audit. Cynthia Cooper she needed to remain independent in her reasonable assurance over the reliability of controls and financial reporting. Cynthia Cooper was also obligated to all parties affected by the performance of Worldcom, such as the shareholders, the employees, the board of directors, and various other parties. Cynthia Cooper's ultimate decision, which led to the finding of the fraud committed by Worldcom, was to expand the scope of the initial operational audit into a complete financial audit. Sullivan, who needed Cooper to delay her internal audit, wanted to fix the accounting issues and hide them in order for them to go unfound. Cooper became suspicious and withstood the pressure to play along. When she asked Arthur Anderson to explain some of these fictitious or suspicious transactions, responded to Cooper saying that they only took orders from Sullivan. Cooper found this very irregular and responded with "Go dig out more information." If she had followed along and played with executives' orders, fraud would have continued and she might have ultimately been found responsible as well in the committing of this crime. Cynthia Cooper had many other alternative choices that she could have made other than expanding the scope of the audit. First, she could have remained silent and halted the internal audit in order for Sullivan to fix the issues. The consequence of this action, the fraud continues and greater consequences and losses might have arisen. She could have lied and cooperated with Sullivan in the fraud and be held equally responsible for the fraud and could have been convicted and sentenced to a term in prison. Lastly, she could have aggressively expanded the scope and gained unwanted attention from executives and other employees, and ultimately the fraud might have been hidden in response to this aggressive expansion. Next, we must look at individuals that played a small role, but a role nonetheless, in the fraud that was committed by Worldcom. Betty Vinson, the Director of Management Reporting, according to her peers, was a hard worker and loyal and would do whatever you told her. She was even assured that what she was doing wasn't illegal and that Sullivan would hold full responsibility for the actions. However, she agreed to make the entries, and she knew that what she was doing was wrong and even thought about resigning at one point. Had she refused to do what she was asked, fraud might never have occurred in the first place. Although it is easy to sympathize with her due to the assurance of what she was doing wasn't illegal, she still committed the acts and the fraud ultimately occurred. Two other parties that could be passed the blame for the fraudulent actions that were committed by Worldcom were first Arthur Anderson, the external auditor over financial reporting. Arthur Anderson viewed Worldcom as an investment, as they made a lot of money off the fees they charged for the audit over their financial statements. Arthur Anderson's risk management software rated Worldcom as a maximum risk client due to the complexity of their products. However, Arthur Anderson audited them as a medium risk client. Even after being informed of suspicious actions, they did not perform tests over the line cost group, which ultimately fraudulently reported these line costs as capitalized assets. According to Anderson's statement on the matter, they were not told of the line cost transfer. However, if Arthur Anderson originally treated them as a high-risk client, they could have detected any of these transactions and fraud might have been discovered earlier. Next, we move on to the board of directors. They were presented false information by Sullivan and Ebers on the company's financial statements. However, they met very irregularly and did little to monitor or influence what was going on at the company. I want to thank you for viewing this presentation. On the next slide, you'll see a list of our citations that we gathered resources from, and I appreciate your time. Thank you.